Fraud is a deliberate act of deception intended to result in financial or personal gain for the perpetrator or financial loss to the victim. It is both a standalone crime and a predicate offence. For money laundering, the proceeds of fraud must be laundered to be enjoyed by the criminal. Fraud and money laundering are deeply intertwined in practice. Fraud generates the dirty money, laundering cleans it. A compliance officer investigating an unusual transaction pattern may simultaneously be looking at fraud typologies and ML typologies in the same case. Main categories of fraud relevant to anti-financial crime, AFC. Number 1. Identity fraud. Using stolen or fabricated identity documents to open accounts, obtain credit, or conduct transactions. Identity fraud is the gateway to almost all other financial fraud types. Without a false identity, most other schemes become significantly harder to execute. Common methods include the use of counterfeit national identity documents, stolen personal information obtained through data breaches or social engineering, synthetic identity fraud, where real and fabricated information are combined to create a new identity that does not belong to any real person, and impersonation of deceased individuals whose records have not yet been flagged in databases. From an AFC perspective, identity fraud directly undermines KYC and CDD processes. If the identity presented at onboarding is fraudulent, every subsequent transaction, credit decision, and risk assessment built on that customer profile is compromised. This is why robust document verification, liveness checks, and database screening at onboarding are critical first lines of defense. Red flags include inconsistencies between documents, addresses that do not match, reluctance to provide original documents, and customers who appear unfamiliar with their own stated personal details. Number 2. Payment and card fraud. Unauthorized use of payment instruments to steal funds from individuals or institutions. This category is broad and continuously evolving as payment technology advances. Card-not-present fraud occurs when stolen card details are used for online or telephone transactions where the physical card is not required. Account takeover involves a fraudster gaining control of a legitimate customer's account, often through phishing, SIM swapping, or credential theft, and conducting transactions as that customer. Authorized push payment fraud, commonly called app fraud, occurs when a victim is manipulated into willingly transferring money to a fraudster's account, often through impersonation of a trusted entity such as a bank, government agency, or supplier. From an AFC perspective, payment fraud is a direct predicate offense to money laundering. Proceeds from card fraud and app fraud must be moved quickly through mule accounts and layered across multiple institutions before they can be used. Monitoring for unusual transaction velocity, atypical payee patterns, and rapid fund movements following account changes are key detection strategies. Number 3. Loan and credit fraud. Applying for credit using false information or with no intention to repay. This category is particularly relevant in the microlending context, where the volume of applications is high and verification processes may be less robust than in commercial banking. Common schemes include inflated income declarations supported by falsified payslips or bank statements, fabricated employment letters from non-existent employers, the use of stolen identities to obtain credit in another person's name, and ghost borrowers, fictitious individuals created entirely for the purpose of drawing down credit. In a microlender context, loan fraud is especially damaging because loan books are the primary asset. Systematic loan fraud can result in significant portfolio impairment. From an AFC angle, loan fraud is also used as a mechanism to introduce illicit funds. A fraudster may apply for a loan, receive the disbursement, repay it with criminal proceeds, and thereby launder money while building a credit history. Red flags include income that appears inconsistent with the stated employer or occupation, payslips with formatting inconsistencies, employers who cannot be independently verified, and applications submitted in rapid succession across multiple institutions. Number 4. Insider fraud. Employees using their access, position, and knowledge of internal systems to defraud the institution or its customers. Insider fraud is considered one of the most damaging categories because it bypasses external controls entirely. Common forms include falsification of customer records to facilitate unauthorized transactions, ghost employee schemes where fictitious staff are added to payroll, manipulation of loan or credit systems to approve fraudulent applications, unauthorized access to customer data for sale to third parties, and collusion with external fraudsters by providing account information or bypassing monitoring alerts. From an AFC perspective, insider fraud is particularly dangerous because insiders may also facilitate money laundering by deliberately failing to file suspicious transaction reports, suppressing alerts in monitoring systems, or structuring transactions to avoid detection thresholds. This intersection between insider fraud and corruption is a major concern for financial intelligence units. Effective controls include segregation of duties, dual authorization requirements for high-risk transactions, regular system access (RAI), views, whistleblower channels, and behavioral analytics that flag unusual staff access patterns. Number 5. Investment fraud. Schemes that deceive victims into investing money on false pretenses. The proceeds generated must then enter the financial system, making investment fraud a major predicate offense to money laundering. Ponzi schemes pay early investors using funds from later investors rather than from genuine returns, sustaining the illusion of a legitimate investment until the scheme collapses. Pump and dump schemes involve artificially inflating the price of a low-value asset through false promotion, then selling holdings at the peak before the price collapses. Advance fee fraud convinces victims to pay upfront fees in exchange for promised large returns that never materialize. Unregistered investment schemes operate outside regulatory oversight, making verification of their legitimacy impossible. From an AFC perspective, the large cash volumes generated by investment fraud schemes create significant laundering activity. Fraudsters typically layer proceeds through multiple accounts, jurisdictions, shell companies, and asset purchases, including real estate and luxury goods. Compliance teams should be alert to customers receiving large unexplained inflows described as investment returns, particularly from offshore or unverified sources. Number 6. Trade-based fraud. Manipulation of international trade transactions to transfer value, move money across borders, or disguise the origin of funds. Trade-based fraud crosses directly into trade-based money laundering, making it one of the most complex areas in AFC. Over-invoicing involves a seller charging more than the actual value of goods or services, allowing excess funds to be transferred to the seller in another jurisdiction. Under-invoicing does the reverse. The buyer pays less officially and transfers the balance through informal channels. Phantom shipments involve payment for goods or services that are never actually delivered. Multiple invoicing involves the same shipment being invoiced and paid for more than once across different financial institutions. Falsified trade documents, bills of lading, certificates of origin, customs declarations are used to support these schemes. From an AFC perspective, trade-based fraud is difficult to detect because it requires cross-referencing financial transaction data with physical trade data, which financial institutions rarely have direct access to. Red flags include transactions with counterparties in high-risk jurisdictions, pricing that is significantly inconsistent with market rates, vague or generic descriptions of goods, unusual trade routes, and counterparties with no verifiable trading history. Number 7. Procurement and tender fraud. Manipulation of procurement processes to secure contracts through illegitimate means, highly relevant in both public sector and large corporate environments. Common schemes include bid rigging, where competing suppliers collude to predetermine the winner of a tender, fictitious suppliers being registered and paid for goods or services never rendered, conflict of interest, where procurement officers favor suppliers in which they have a personal financial interest, and invoice fraud, where legitimate supplier details are substituted with fraudulent banking details to divert payments. From an AFC perspective, procurement fraud often involves public officials and generates proceeds that are then laundered through real estate, offshore accounts, or legitimate business activity. It is a key predicate offence in corruption-related money laundering cases and is closely monitored by financial intelligence units across Africa. Number 8. Cyber-enabled fraud. Fraud facilitated by digital technology and cyber intrusion. This category is growing rapidly and intersects with almost every other fraud type. Business email compromise involves fraudsters impersonating executives or suppliers via email to redirect payments to fraudulent accounts. Phishing and smishing use deceptive emails or SMS messages to harvest credentials or personal information. Malware and ransomware attacks on financial institutions can result in data theft, system compromise, or direct financial loss. SIM swapping involves convincing a mobile network to transfer a victim's number to a fraudster-controlled SIM, enabling interception of one-time passwords. From an AFC perspective, cyber-enabled fraud generates illicit proceeds that move at high speed through payment systems, often crossing multiple jurisdictions within hours. Detection requires real-time transaction monitoring, strong customer authentication, and rapid response frameworks that can freeze suspicious outflows before funds are layered beyond recovery. Number 9. Money mule activity. The use of individuals, wittingly or unwittingly, to receive and transfer fraudulent funds on behalf of criminals. Money mules are the connective tissue between fraud and money laundering. Mules may be recruited through fake job advertisements promising easy income, romantic relationships where the fraudster builds trust before making requests, or outright coercion. Once recruited, mules receive funds into their accounts and are instructed to withdraw cash or transfer to another account, keeping a small commission. From an AFC perspective, money mule accounts are detectable through specific behavioral patterns, accounts that receive large inflows and immediately transfer out with minimal retention, multiple inbound transfers from unrelated third parties, and transaction patterns inconsistent with the customer's stated profile. Institutions have an obligation to identify and exit mule accounts and to file suspicious transaction reports on activity identified as mule-related. How fraud links to the money laundering cycle. Fraud is the predicate offense that generates criminal proceeds, which then enter the money laundering cycle across 3 distinct stages, each requiring specific anti-financial crime controls to detect and disrupt the activity. At placement, fraud proceeds enter the financial system through mule accounts, collecting victim payments from investment scams, card fraud, or app fraud. The primary controls here are robust KYC at onboarding, source of funds verification, and transaction monitoring configured to detect unusual inflow patterns from unrelated third parties. At layering, funds are rapidly moved across multiple accounts, institutions, and jurisdictions through wire transfers, cryptocurrency conversions, and foreign exchange transactions, deliberately fracturing the audit trail. The controls required here are real-time payment monitoring, cross-border transaction alerts, SDR filing, and network analysis that identifies relationships between apparently unconnected accounts. At integration, laundered funds re-enter the legitimate economy through business investments, real estate purchases, or asset acquisitions, presented as legitimate wealth. Enhanced due diligence, source of wealth verification, adverse media screening, and ongoing transaction monitoring are the critical controls at this stage. Each stage represents both a criminal opportunity and an AFC intervention point. No single control is sufficient on its own. Robust fraud detection and AML monitoring must work together across the entire customer lifecycle to effectively disrupt the full chain of financial crime.